markets right now, an ice-cold start to the year for initial public offerings, with 0 IPOs in January, making it the first month-long drought since 2011. This has brought markets look to rebound from the worst beginning of the year since 2009. Joining us right now is Federated Investors Chief Strategist Phil Orlando. Phil, good to see you.
Good morning. Thanks
so
for
much
having
for joining
me back.
us. So the worst start to any year in 2016 for the markets, it was brutal. Are we still going to see that performance, you think? How do you characterize things?
Well, it's going to be a challenging year, but you look at that month, it's sort of the tale of 2 months. You had an 11% correction in the first couple of weeks. You've had a 6% pop here in the last 7 trading days. And the thing that's occurred, the ECB, Wednesday before last, very accommodative. Our central bank seemed to back away from this 4 hikes over the course of the year, and then Japan with the negative interest rates on Friday morning. So suddenly I think the market thinks that there's a little bit of a central bank put that's in place again, and they've got a little bit more confidence. But from an economic standpoint, we've still got some challenges out there.
So what does that say about markets, that it's all about the central bank once again? I mean, it's the Federal Reserve, it's the Bank of Japan. No fundamental, backdrop in terms of vibrancy in the economy. No fundamental economic stats that show things are better. Just more central bank monetary policy. Well,
you look at the data. Friday we flashed fourth quarter GDP 0.7%. I mean, that's terrible.
Exactly.
We should be growing at 4 to 5% at this point in the economic cycle. And based upon sort of our view of what's going on, we're going to be bumping along at about 1% for the next couple of quarters. So I think investors are legitimately concerned that the economy is a lot slower than it should be.
My question is, can the banks, to Maria's point, continually, whether it's the ECB or the Fed here, can they prop up the reality in the economy? Contraction, we talk about China manufacturing going down. That's also in part because consumer participation drops in their markets. They're not buying the product. The product is obviously lessened. The banks can only manage decline for so long before we have to face the reality.
That's effectively my question. I mean, you're exactly right.
And Phil, and what do you tell the average investor who's saying, oh my goodness, they're looking at their 401k, so getting through all the stuff, the high-end stuff that we're talking about, what do you tell the person who's on his treadmill right now or her treadmill? Like, what do they do?
Well, our view at the beginning of the year is that we were going to be in for a little bit of a rocky road. We thought we would have some support levels lower. We, as I said, dropped 11% here in the first 3 weeks or so. I don't know that we're completely out of the woods yet. We're hoping for some better economic news in the second half of the year based upon some developments. But obviously we've got a couple of tough quarters that we need to get through before we see some stronger, more trendline economic growth.
What about the impact of it being an election year, and there's the possibility that you have the Democratic nominee who's a socialist who wants to take the top tax rate? I mean, hey, it's not 90%, it's going to be about 54.2%. Tax capital gains and dividends for wealthier people as income, regardless of how long you hold a stock. How does that weigh on the market? Because certainly it would make people nervous at home, but what about how they act with their money in the market?
No question. As we sit down and look at what's going on in the market and what's got investors concerned, everyone's talking about China and oil prices and what's the central bank going to do, but one of the 6 things that we're focused on is the election. For this reason, with economic growth sort of limping along at half price, the fiscal policy approaches of the various candidates are going to be critically important. So starting today with Iowa and sort of working our way through the year, thinking voters and investors are going to be very interested in what the different candidates are saying from a fiscal policy standpoint. Obviously, I'm not a fan of what Senator Sanders is talking about from a fiscal policy standpoint, but that's for the voters to decide.
Did anything change since the Bank of Japan went negative on rates? That seemed to be a catalyst for markets. Do you think that shows anything different in terms of a reason to invest in equities?
Well, so as I said, you had the 6% bounce over the last 7 trading days. We had about a 2.5% move in the U.S. here. And what happened with with Japan, is that was the 3rd major developed economy or developed central bank that made a positive supporting statement. you know, the ECB a couple of weeks ago, the Fed the middle of the week, and then Japan. So from the perspective of the central banks, we've now got a central bank put, if you will. But we need better fiscal policies to coordinate with the monetary policy, and we need better activity within the economy based upon what individual consumers and corporations are doing, and we're not there yet.
So it sounds like you said we're not out of the woods yet. This market still has some volatility and,
Right.
and declines to come. But you feel like over the short term, the central bank action is a positive to perhaps.
It's certainly supported, but we're concerned that after a bounce here, we may see a retest lower, and so we are advising our clients to be cautious here and wait for a better opportunity to put all their chips back into the table.
And certainly some better data.
How about the IPO market? That's something you need as a foundation for the broad market to move higher. And again, there were no IPOs in the month of January.
Well, and that's telling.
Right.
If companies...
It started last fall, too.
But that's more of that's not necessarily a catalyst as much as an indicator, right? I mean, there are no IPOs because why would you go public in a tough market?
Right. Exactly.
So,
investment bankers are not going to bring their stocks forward if they think the environment is poor, if they can get a better price later.
But because you've had the bounce, they need to step up now and do it in order to send the signal to the broader market that, like, we're comfortable enough to take this company public right now.
But if they're not doing it, that suggests that they're not comfortable enough to take those companies
and they're probably
public.
not.
And I think that's the signal. I'm sorry.
And to your point, Dagan, this started last year. It didn't, January 1, they didn't make the decision. The decision was made after looking at the last 2 or 3 quarters last year.
Right.
Right. Neiman Marcus was the signal that luxury was going to stink to high heaven, and doggone if it didn't over the holidays.
Well, you know, talk about the labor market. We've got a non-farm payroll coming up on Friday. Now, one of the things, or two of the things that we're looking at is that a lot of the smaller independent energy companies are announcing layoffs. A lot of the big brick and mortar retail companies are announcing layoffs. Our model for this Friday is below consensus. Consensus is looking for about 2.5, 2.10 or so. Well, we're in that 190 neighborhood. We think we're starting to see some of those layoffs filter into the economy. So if we start getting poor labor data, which has been, you know, one of the real linchpins in the economy, that I think is going to create some additional concerns for investors as well.
I will say 185 is what I was looking at for the Friday number, but you're right, there are estimates as high as 210 in terms of number of new jobs created for the month of January. Phil, good to see you.
Thanks for having me.
Thanks so much. Phil Orlando joining us from Federated.